All right, let's talk about the state of the market. And this is for everybody, but I also want the people who are members of Copy My Trades to know where we stand right now. Some people are worried because in this system we have mainly short positions, and there's reason for that. Um, I could talk about this for a long time, but I'm going to try to keep it simple and to as few points as possible. I want to start out. Let's start out looking at gold, okay? Because there's something important happening with gold that we haven't seen in the past. So here's the ETF for gold, and we're at an all-time high. Now, one of the positions we have is holding an option on this gold, and because we play options, we played this before when gold spiked, we sold it, and if you're wondering if we sold it too early, the answer is no, because when you play options, there is no such thing as buying high and selling low, simply because you can choose the price of the option. If you think that gold is going to continue upward, then you can buy an option at pretty much any price. So don't worry about buying highs and lows. Just worry about what's going to happen with gold and taking profit when you think it's going to drop, getting in when you think it's going to move up, even if it's not at a dip. Now, what's interesting about gold is that it continued to move higher in spite of the fact that the market moved higher as well. Generally, what happens is when the stock market moves up, gold tends to move down. So let's take a look at the S&P. Now, usually at this time, when you see the S&P falling, gold will go up. That was in January. So that's when we saw gold starting to go up. Now, when the market rallies like it did last week, gold should go down, but that didn't happen. Gold continued upward. Check this out. Do you remember the rally in October? Gold dipped, right? That's usually what happens. That's what's supposed to happen. But why didn't gold go down when we saw the market go up? Well, one reason for this rally that we're seeing here is simply short covering. And this is going to bring us to the first point. Don't you think it's a little strange that on Friday at close, the S&P 500 index hit pretty much exactly 2,000? That's very improbable, but it's not super unlikely. However, when you look at that, and then you also look at the Dow Jones, let's take a look at the Dow Jones index. You'd see the Dow Jones also hit a very round number, 17,000. It's almost like there are targets that someone's trying to hit. And I'm not gonna say this is a conspiracy. I think it's actually pretty out in the open. But the world's governments are pumping money into the stock market, and they've been doing that for a while now. If you look at an article I wrote, Seeking Alpha, you will see that I gotta sign in, but you'll see that we have a couple signs that are very similar to what we saw before the crash in 2008. So I'm just gonna go to that article and show you the images there because it's convenient for me. SPY, here we go. So, problem with the market these days is that people don't know what to do with their money. The US used to have a really high GDP, and it still does because we include services in that GDP measurement. But we don't really produce anything. And if you looked at GDP as pure production, you would see the US is probably not going to be the highest GDP anymore or in the future because we have outsourced most of the production to other countries, especially China. So what are companies doing with their money these days? Well, they're buying back shares. Here is the buyback situation in or prior to the crash in 2008, and here's our buyback situation at present. When companies don't know what to do with their money, they either buy back shares, which artificially inflates the price, or they increase dividends. Now, obviously, increasing dividends would be better for the investors, but that's not what they're going for here. I think a lot of them just want their companies to look better, so they buy back shares. That reduces the outstanding shares and therefore increases the price of the stock. Now, that's manipulation by companies. Manipulation by government is printing money to buy stock, putting it in the stock market. And recently, there is the G20 meeting. And during that meeting, all the companies were discussing how to, not companies, all the countries were discussing how to find a method to make the economy stable, the world economy stable. Now, interestingly enough, the meeting was on the 26th, which was Friday, and the market started to rally the next week. It looked like money was being pumped in to the market. So let's go back and look at the S&P. So here is last week, and if we take a look at the Chaikin oscillator, we can get an idea of how the money was being pumped in the market. If the oscillator goes upward quickly, lots of money is being pumped in. This was a combination of short covers and market manipulation, and that's what we're seeing right now. Now we've hit 2000, which is just amazing, right? What a coincidence. Well, what's going to happen next? That's the question. Are our short positions going to hurt our portfolios? Are they going to pay off? That's the question we need to answer to know whether we should continue holding onto these short positions or sell them. Well, when you look at many indicators, you will find that what we're looking at today is almost an exact parallel of 2008. 2008 was a type of debt bubble. It was a mortgage debt bubble. What we have now is more of a government debt bubble and a consumer debt bubble. Like I said, I don't want to get into I don't want to make this too complex. You can search the news for consumer credit and outstanding debt. There's also a job report that came out that appears to be good, but when you think about it, it's not so good. A quick example would be because jobs were up, people thought that means the economy's better, but there are two things wrong with that. One is jobs are a lagging indicator of the economy. They don't really predict the future. And second, jobs being up doesn't necessarily mean that we have a lot of business to do. It could just mean that people don't have enough money to pay off their debt, so they're taking two jobs. I don't want to make this too fundamental. I just want to show you that the indicators show that we're probably at a top and we are going to expect some sort of market crash soon, at least a major correction. Now, back to this idea of gold going up while the stock market also goes up, which is very strange. What that should tell you is that gold is a pretty good measurement of fear, actually. So what that should tell you is that people are hedging their portfolios with gold. That's a smart thing to do. You should always be hedged. Right now, I'm not hedged in my portfolio. All of my positions are short at the moment, but I'm hedged in terms of currency because I live in Japan. If the market rallies, the US dollar index typically rallies as well, and I show that in this article. Here's the US index. It's also rallying. My dollar goes a lot further when in Japan here when the US stock market goes up. So I'm hedged that way. But you should also be hedged in whatever manner you want. You can, because right now our positions are mainly short. You will probably want some long positions. You could, for example, buy puts on the VIX. You can short gold. I wouldn't recommend it, but you can certainly do that. But the idea here is that it looks like we're probably at a top. And why do I say that? Well, what is the ticker for that? McClellan. What is it? McClellan oscillator. I'll just type. There we go. Oscillator. Spelled it wrong, but we'll get it. There we go. All right. So, let's check it out. This is not what we want to look at. Alright, so what is this oscillator? This is a pretty good indicator of when the market is overbought. And by the way, what we usually use to look at a overbought signal is the stochastics. When the stochastics are above 80 and when they're above 80, we're pretty much overbought. And when the black line starts to move downward below the red line, that's generally a pretty good short or sell signal. Now, it's pretty rare that we hit such a high level. We're almost at 100. So this is telling us that the market is significantly overbought, and we haven't even gotten back to the 2,100 level that we had earlier. We're not at a high. We are having lower highs than before, and that is a problem because that's telling you we have a general downtrend of the market. Now, back to this oscillator. What is the ticker for this? Ticker for, can't ever spell this, McClellan oscillator. McClellan oscillator. Not a good speller at the moment. Let's see here. We can actually look at this in stock charts. I don't know why it doesn't tell us the ticker. Oh, there. Nope. Is that right? I think there's a more general one. That could be it though. $sign, oh, this one. $sign NAMO. So let's take a look at that. $sign NAMO. So that's our oscillator. This is telling us whether it's overbought or not. And then the oscillator also tells us whether it's overbought. Now we are at, and I think this is an all-time high. This oscillator is giving us a 80 plus signal, and it's turning downward. Now when it turns downward, the momentum of the market goes downward. Because we're at an all-time high, can we actually track this with, well, we're gonna have to go back and forth, but usually when you hit like the 50 level, the stock market goes down. So let's actually hit SPY and see what happened to that at those times. Wish we could track it together, but I don't have the membership for this. So in October, we were at a bottom, right? And that was preceded by a 50 level in late September, which we can't go back and see, but it's around here. So if you were to align this with the SPY, you'd see that the turnarounds, which start at the red, tend to signify a downward trend in the market beginning. It's probably useful to compare this, we're at 82, right? To compare this with 2007, which was when the, okay, good, we got it. Which was when the stock market was at an all-time high at that point, and officially the economic recession began in, I believe, June of 2007. So the recession it wasn't determined in 2007, it was determined in 2008, but it was retroactive. So analysts, who are always slow, a year after the economic recession began, said, oh, it began a year ago. So let's see what happened there. Is this the best we got? Okay, this is the best we got. So this was 2007. This is 2007? Yes, this is 2007. All right, so in 2007, in October, the market was actually at a high, and we got this 50 level again, and it went down and basically crashed. Now we're at that point again. It'd be nice if we could see 2008 with this one, but you're going to see that we are at a higher high than we've been with this indicator, and it's turning downward. You're going to have to do your own research on that, but that's the fact right there. Okay, so what's the problem here? Well, the problem is the rally was probably created by people pumping, by governments pumping money into the stock market. Now, did we miss the rally? Yeah, we missed the rally, but it was somewhat unpredictable. What is more predictable, though, are these indicators, are the overbought indicators that we're seeing here. Now, because of that, it's safer to be short than to be long. If you're long, you have a lot of capital to lose. But if you're short, based on these indicators, you might be getting in a little late. You might not be shorting at a high. It could go a bit higher before it starts to fall, but at the very least, you're betting in the more probable direction. Now, we opened a lot of short positions at the end of February. That was a relative high. I thought that would be the high, but the government said, no, sorry, Damon, that's not going to be our high. We're going to keep going a bit before all this stuff blows up. So that's why we have a lot of short positions open. Like I said, you should always be hedged. Take my Copy My Trades subscription as advice to make profit. It's not supposed to be your entire portfolio. So where do we stand right now? Well, we stand with those positions still open. There's no reason to close unless you step back and rethink the position and ask yourself the following question. If I had to open this position now, would I do it? And if the answer is no, then close the position. But all the positions we have open in our subscription, if I were to step back, I would say, yes, I want to be long on all of these. Okay, so I hope that should answer your questions. There's a lot of other information that I could talk about. I don't want to make this too long. It's already been 20 minutes. No, I'm not going to do this. I'm not going to do this now. We could talk about one quick thing. Let's see. I'm going to grab a book called The Trader's Almanac. This is from 2015. And 2015 we did see a rally, and that was statistically expected. We want to play the statistics. Now in Copy My Trades, we make a lot of statistical plays. We also make arbitrage plays. These are all high probability trades. For example, if we make a gap trade, I always run my algorithm on it to determine whether it would be profitable in the long run. The arbitrage plays are, well, they're arbitrage, so they usually work out unless, for example, a merger doesn't go through. But for other general momentum trades, statistics really help. And the reason I took a lot of bullish positions in 2015 was because we had a very nice combination of statistical historic patterns for 2015. First of all, 2015 is a pre-election year, and pre-election years almost always go up. I don't think they're here. Pre-election years, no losers in 76 years. So far in 76 years, in the past 76 years, which is probably older than you or I, if we had just bought the SPY outright at the beginning of the year and held on and then sold at the end of the year, we would be profitable every single year. That's pre-presidential years statistics, plus 2015 is the 5th year of a decade. And in the 5th year of a decade, you probably can't see this, in the 5th year of a decade, there are also very, very few losers. They have the best record for the stock market. So you got that. There was another, the 7th year of a presidential term was also 2015, and they tend to be very, very good as well. So 2015, statistically, was a great time to take bullish positions, and the majority of my positions in 2015 were bullish for that reason. Now in 2016, we're looking at a lot of ugly indicators, and because of that, we're going to be taking mainly short positions. So if the market's rallying, it's certainly going to hurt us, but we don't realize that hurt unless we close our positions. But in 2016, we're going to be taking mainly short positions because the indicators are telling us we're looking at something that looks a lot like 2008. And if we were short in 2008, we would have made a lot of money. That's what I'm planning to do in 2016. I hope this answers your questions. I'm going to make this video public so that other people can get some info from it. I didn't give away pretty much any of our trades except for the fact that we're long on gold. So I hope everyone's happy with this. If not, please let me know. That should be it. If you got any questions, you can always email me. But this is it for now. 20-minute video. I broke it down into some pretty standard, simple ways to understand why we're so short on this market and what's probably going to happen in the future.